Hi, my name is AADHAAR and my topic is monetary policy. So, starting a presentation on monetary policy. So, coming to definition, what is monetary policy? So, monetary policy is an economic policy that manages the size and growth rate of the money supply in an economy. It is a powerful tool to regulate macroeconomic variables such as inflation and unemployment. These policies are implemented through different tools, including adjustment of the interest rates, purchase or sale of government securities, and changing amount of cash circulating in the economy. The central bank or the similar regulatory organizations is responsible for formulating the policies. Now, coming to the objectives, the first objective is inflation. So, the monetary policies can target the inflation levels. Low level inflation is considered to be healthy for the economy. If inflation is high, uh, contractionary policies can address this issue. Second is the unemployment. So, monetary policies can influence the level of unemployment in the economy. For example, an expansionary monetary policy generally decreases unemployment because the higher money supply stimulates business activities that lead to expansion of job market. And the third is the currency exchange rates. Using its fiscal authority, a central bank can regulate the exchange rates between domestic and foreign currencies. For example, the central bank may increase the money supply by issuing more currency. In such a case, the domestic currency becomes cheaper related to its foreign counterparts. Now coming to the monetary policy tool. The first monetary policy tool is okay. So first, the central bank policy reforms majorly deal with economic recession and expansion. The prominent tools used for this purpose involves first is open market operations. The central bank purchases short government assets such as U.S. Treasury bonds and or federal assets in open market operations. If the central bank is targeting recession, it will purchase the securities from bank offering them. This will increase the bank's cash flow and reserve. Doing this at the macro level will increase the money supply in the country. In contrast, when it plans to reduce the cash flow, it sells the security, reducing the reserves and availability of cash. The second is reserve requirement. Changes in central banks prescribe limit of reserves that the commercial banks need to maintain from their customer deposits in an essential tool. In the situation of economic expansion, the reserve requirement is increased to decrease the money supply in system. On the other hand, it is decreased as a part of expansionary policy. The third is the discount rate. Sorry, the central bank changes an interest for short term, leading to the commercial banks, which is referred to as a discount rate. The loan helps in meeting reserve requirement and short term cash flow. If the cash, if the bank increases the discount rate, it eventually permeates the other rates, including those on commercial loans. As a result, increasing commercial loan rates will discourage people from borrowing, thereby bringing down more money supply under inflation. Now coming to types of monetary policies. So first is contractionary policy. The central bank adapts contractionary monetary policies to control the economic conditions like inflation by shrinking the money supply in the financial system. For this purpose, the central bank sells off short term government securities, hikes borrowing rates, and increased banks' reserve requirements. And second is expansionary policy. In situations of economic slowdown, the central bank implements various expansionary policies like buying short-term government securities, lowering borrowing rates, and decreasing the bank's reserve requirements. The purpose is to uplift the money supply in economy for exchanging consumer spending and decreasing unemployment. However, it may result in inflation. Thank you.